on December the 22nd, 2023.
There you go.
You had a very good year in 22, hadn't you?
We had. I mean, relative. We were only up 5 or 8% or something, but
Market was down.
Market had a shocker. So very solid relative.
What was MSCI World? Must have been 7, 8 down?
Yeah.
Is it more than
Probably.
Yeah. Short 10 down. Yeah.
Enjoyed the letter. Thanks for that.
No worries.
It was very good, and it was very timely.
Yeah. Well, sort of. I had to force 2 readers to read it.
I really enjoyed it. It was very good, actually.
Good.
It's yeah, we'll probably. I like the way you strip out the EPS growth and then kind of relative NAV growth on the side.
Yeah.
That's quite. I don't think we see many people do that.
No.
Terry Smith strips out various ratios.
You can back it out for Fundsmith, but he doesn't give it to you.
No, I like the way you do that. That's.
I've never seen anyone else do it.
No,
I think it's unique.
It's a bit too honest, isn't it?
Well, it is in a way, but I think it's really nice clarity for us when we're building the portfolio that we're focusing on.
Yeah,
that fundamental growth.
It's quite amazing though. Since 16, the EPS growth has been. Yeah, to go from £4 to 16 is...
Well, that's the power of it. And, in the next 10 years...
It's quite amazing.
It is, but in the next 10 years, I truly believe that'll be 60-something.
Do you?
Yeah. 15% a year. I think these companies... I mean, half the stocks are the same ones we owned then. They're just still doing what they were doing, So, yeah, that's what we think.
Did you sell Diageo? We've still got it.
No, we still got Diageo.
We've still got it. Right, I'll ask you about that then.
Oh, we're definitely...
Everyone asks about that.
No.
It's a vested interest.
That. Oh, dear. Fun and games. Okay, well, if you're ready, Alex, we'll start, are we? Good. Hello, everyone, and welcome to Taking Stock After the Bell. Good to see you again. Episode 60, returning fan favourite, Freddie Lait. Freddie is the founder of Latitude Investment Management, running the Horizon and Global funds. One is a long-only global equity fund, and the other is a multi-asset mixed fund for those who don't want all equity exposure. So, Freddie, welcome back. We've shortened the biography today. Those who are keen to go and revisit the first effort 2 years ago can go find it on episode 22. It was a long time ago. So, Freddie, good afternoon to you. Thanks for coming along.
Thanks for having me. Busy start to the year, you said, presumably. Lots going on. Yeah, it's been an amazing start to the year. I mean, mostly news coming out of America, but also, market volatility, whether it's precious metals or Japanese yen or stock markets, it's something for everyone. Precious metals. Oh, let's not go there. Up another gold 5,000 today. Fantastic. Donald Trump doing what he's doing. But you sent us your annual newsletter on Friday, which was good. I really very much enjoyed the opening, musings analogy for the dog on a lead. Do you want to sort of set the scene and how you think about investing in terms of that analogy that you put in your letter? Yeah, I mean the analogy is, if you're walking across a park and you're sort of heading over at a steady speed towards your destination, and you've got a dog on a lead, the dog will swing violently from both sides and lurch around. But at the end of the day, it will follow you on that path and it will end up in the same place as you. And I think, the path is the underlying fundamental value of a business. And the path, the dog is clearly stock prices, which are much more volatile. And I think that is a great advantage for a public equity investor to rationally use that dog's erratic behavior to your advantage. And I think the second order thing is that you really need to focus on the fundamental value of a business. And I think the best way to proxy that is to look at the earnings per share or cash flow per share of a business and how much that grows over time. And not just at a stock level, but at a portfolio level. Yep. And so, we report our portfolio level earnings per share and how that's grown over the last 10 years. It's generated sort of 15% a year growth. And the share price performance of the fund is roughly in line with that. And we expect over the next 10 and 20 years that to be the case. And so when we're thinking about investing, we're thinking, how do we maximize that fundamental growth while minimizing the valuation? And we've got that chart here on, I think what you call fundamental growth. And we've got a bar chart here of 2015 through 2025. So the last 10 years, the blue bars are the earnings per share of the portfolio, essentially growing at 12% a year with 3% dividend on top. And that takes the
the earnings from 100 to nearly 400 quadruple over that 10-year period. So it is, that compounding at 15% is quite powerful, isn't it?
Yeah, it's very powerful. That is, how we think about fundamental growth. I think it's quite important to include dividends. Often people ignore them, but it can make quite a big difference. And so we include dividends. Obviously, if you get a cash dividend in a fund, you're able to buy more shares with that and implicitly own more of the company's earnings. So I think that's the only right way to think about it. And yeah, that's an illustrative chart, but the actual earnings and dividends for the fund have been very similar to that over the last 10 years.
And what do you do when you receive the dividends? Do you just, do you allocate as per new ideas, or do you top up the holding that the dividends come from?
So generally we allocate to new ideas or across the portfolio rather than systematically investing back in a business. Often a business with high dividends has lower investment opportunities. It's got lots of free cash flow. It's returning that cash. It's actually often better to recycle that into other businesses. But we have nearly a 3% running dividend in the fund, which is quite high. That's almost the average size of our holdings. So each year we get a free stock.
A free stock. That's a good way of thinking about it. Is that, it's for the sort of DIY investor then, buying accumulation units of the fund where the dividends automatically get reinvested? I think that's quite a powerful idea for a lot of investors, isn't it?
Yeah, I think 93% of our clients invest in the accumulation shares. I think that is the most intelligent way to do it. It also, the fund trades every single day. It's highly liquid. So if you need money, you can always take some out rather than taking it as income.
In your pack, you've also got this chart on the US equity market, breaking down the return going back, nearly 75 years now, since 1954. The market itself has done 11% a year compound.
Yeah, that 10 or 11, yeah.
10, 11, and we can see how that's broken down. You've had your 3% dividend there, which is the dark blue bits in this chart. And then the main kind of block, if you like, of return is that slightly lighter blue color, which is the earnings growth, the profits growth itself. When people sort of think about the stock market, lots of investors will think, it's just gambling, isn't it? Well, no, it's just some companies and their real assets, and they're, Microsoft or Apple, whoever it might be, and they grow their profits each year. And because they grow their profits, that's why the share price goes up. And that's what the chart is telling us here, right? Yeah,
that grey bit at the top is the bit that I would put into the gambling category. If you're taking a view on what other people will pay for something in the future, then that is closer to gambling and playing much more into luck, I think, than skill. But if you're trying to pick businesses that have delivered strong fundamental growth and you believe maybe will continue to do so, and you just wait to pay a reasonable price or a cheap price rather than overpaying, then you can put yourself with a massive tailwind. And so I think that's the key thing. And the other thing to point out is that this sort of split is true over pretty much every 10, 15, 20 year time frame. Any long period of time you take, it's true, but there's never been a larger contribution from that grey bar than in the last 15 years. If you just split it into the last 15, 4% a year has come from the market getting more expensive over 15 years.
And can we justify that? Or do we think over the long term that gives it back?
Look, I think it was probably cheap 15 years ago. That was sort of the depths of the financial and European debt crises. Yeah, this is the chart that just breaks it down since then. And so, but the key thing for me here is, for all the bluster and all the exuberance about the American stock market, the fundamental growth has been basically bang in line with the long-term history.
Okay.
Yeah, around that 9 to 10% level. Yeah. That's what the companies have delivered through this tech revolution and America first and huge margin expansion post-COVID. That's still what they've managed to deliver. And it's worth remembering that first chart, which is the post-war period, includes quite a lot of revolutions. The internet, electricity, refrigeration, commercial flight, an enormous number of things happened to deliver that 9%. So it's not unusual that we have our own things. Yeah. But I think betting on even the best market in the world delivering fundamental growth substantially ahead of that's quite hard. So there are some reasons why the market re-rated from that level, but I do feel like it's quite expensive as a whole these days.
Yeah. And as I look down the EPS growth within your annual letter, there's never been a year where the companies you own have overall you've seen a fall in EPS. I mean, between 22 and 23, I think it was flat. But if I think about what a lot of businesses did around COVID, there were pretty big downgrades in EPS, and 2019, you had EPS for the portfolio of £7.30. In 2020, it's £7.90. December 21 was £11.20. There's really good compound earnings growth. And that's quite different to what the market did. Is that your kind of fundamental analysis in the types of businesses that you own?
Yeah, I mean, not deliberately different, but the way we do research is we try to find companies we think will deliver at least double-digit fundamental growth.
Yep.
That's what we're lining up, businesses where we really understand their competitive position and where they might be in 5 or 10 years' time seems straightforward to us. So not the highly disruptive industries that others seem to be focused on today. And we'll just basically line them up and buy the cheaper ones. That's in a very, we tend to own stocks for about 10 years. So that's not a kind of every morning recycling of capital. We normally add 1 or 2 a year, but that's the framework. And so we've ended up, especially in the last 5 years, with quite a different portfolio. Only 5% of our returns overall since we started the fund 10 years ago have come from tech. Right? As an example, right. And it's driven 50% or whatever it might be of the market. So we've ended up generating returns in a different way. We think in a more durable way, overall in a more defensive way as well. We do have a few cyclical stocks like JP Morgan or Ryanair, but in general, it's quite defensive. And, one of the reasons why it held up and has done quite well performance-wise is the valuation. The fund trades cheaper than it has in the last 10 years, which comes onto the opportunity today, but it's on about 14 and a half times earnings. And the stock market's probably on 21, 22.
Yeah, it's a lot.
It's something like that. So it's 50% cheaper. Yeah, over the last 10 years, MSCI World's earnings, in the same framework as ours, have grown around 10.
Okay.
So 50% faster growth, but 50% lower valuation.
A couple of stock examples here. One stock that you do own and one stock that you don't, which I think is quite a good way of bringing your kind of fund and your stock selection decisions to life. We've got 2 stocks on the chart here, McKesson, or we'll start with Costco, which is the stock that you don't own, which is the great US cash and carry. Are we allowed to call them cash and carry businesses, or they've got a posh name for that? Where we can see the earnings bars of blue have progressed very nicely, 12% a year. Forecast in lighter blue is set to carry on growing. But obviously the yellow line is the share price, which is seemingly detached from the reality. And Costco is now 50 times earnings or something silly like that. Yeah. And then compare and contrast to McKesson. I mean, do you want to sort of explain what McKesson does and the sort of the contrast between the two there?
Yeah. I mean, this is really just putting into context this idea of, relative valuation rather than absolute. Not playing the game of saying, I'll buy that stock because I think someone else thinks it's worth more. Buying the stock where you think you'll get similar or greater levels of fundamental growth at a cheaper price, and always trying to minimize that valuation. And so once you've done the work and you believe 2 businesses are highly competitive, very well placed in their industries, have similar levels of structural fundamental growth, and we think the same is true with these 2. So Costco is basically a wholesale distributor type model, but it does sell to retail of groceries and some wholesale, other sort of goods. And McKesson is a drug distribution business. It's a third of the market share. It basically sells some of everything in American drugs and distribution in prescription drugs and pharmaceuticals. Quite similar business models, very thin margin, very, very high revenues, hugely dominant in their spaces. But McKesson was trading at 11 times earnings. The last 10, 20, 30 years, it's generated a very similar level of growth to Costco, that kind of low teens, 12, 13% a year. Stock I've known for about 10 years, like Costco. Costco at the time was trading 35 times earnings. And we would always make that decision because we believe their futures fundamentally look quite similar, that we know where they're going to be and what they're going to look like in 10, 20 years' time. They're very easy to understand businesses with a similar business model. And yet one traded on 3 times the multiple of the other. And Costco is a very, very popular stock. It's very well known. There's been books written about it. Charlie Munger, Warren Buffett's business partner, was on the board and the largest shareholder for a long time. So it's always had this sort of fan club that drove the valuation to a different multiple. And I would argue the same is true with tech these days. There's a big retail following of tech. It's obviously the hot sector. AI's going to change the world in many ways. I'm sure it will. But it doesn't mean the stocks are rationally more expensive. It just means they're more expensive because they're more popular.
And then theoretically, come back to this chart, if Costco were to fall by 60% tomorrow and it would be on 20 times earnings, might that be a stock that would be included in the portfolio given its fundamental
So
drivers?
It would depend what else we had, but if we had McKesson still, and that was really the source of funds, so to limit our choice to just this slide, it would have to fall far more than that, because it would be on the same multiple for the same fundamental outlook, not worthy of a trade. And what we tend to look for is a much wider margin of safety when making a trade than that.
Okay. But I mean, Costco is one of those stocks, isn't it, that sort of most fund managers seem to fall in love with. And you look at it, it's on 50 times earnings, and you just kind of scratch your head a little bit. But that's not necessarily for me. And the portfolio does look very different to a lot of global equity funds. I mean, it's not stuff full of Microsoft, Nvidia, and Apple. So I've highlighted a couple of stocks, one closer to home, one slightly further afield, and perhaps we can touch on a few others as we go along. But I mean, Tesco is one of your core holdings, isn't it? Been in the portfolio a while. We'll put the share price chart up here. Had a pretty good year, actually, didn't it, Tesco, to be fair?
Yep. And that probably is just a share price rather than total return chart.
That is a share price.
It misses an average dividend yield of about 5.5% a year over that period.
Yep. Next time
we'll get John to update the slide. Don't worry, Freddie.
No, but it's doing very well anyway. But it has paid some really substantial dividends over that period. And it's starting to get recognised in terms of the share price. I mean, the shares are still on 14 times earnings. We have owned it for about 10 years. It's been a very strong contributor to the fund so far in those last 10 years. But contrast it to Costco or Walmart in America, which is a weaker version, interesting for different reasons, but trades on about 38 times earnings, I think, from memory. Tesco's is, and it really comes down to, again, this work on the competitive position. Everyone says it, well, lots of people say they look at competitive moats and all the rest of it, but then they just own loads of tech stocks that are about to get AI disrupted, and maybe their moat wasn't quite as wide as you think. But when you look at Tesco, the main change in the competitive dynamic has been twofold. One is that Tesco was in a real hole 10, 12 years ago, and it got itself out. I won't go into it, but has done a lot to fix its business, right-size its pricing, right-size its customer and supplier relationships, and it really got itself back in the ground. So its execution was coming through very strongly. And then the second thing is that Morrison and Asda were both taken private. And basically between them, 100% of their free cash flow is paying interest now. They have no position to come back and attack on price. They have no position to invest. We've seen the headlines around their technology being weaker. And Tesco's has been stealing market share for the last 5 years. And market share gains in businesses with massive fixed capital and fixed cost bases is hugely lucrative. Because in simple terms, Tesco makes a 4% operating margin roughly. But if you get another 1% of footfall, one person more out of every 100 comes through your store, yes, you need more bananas to sell them. That's your cost of goods gone. But you don't really need more people to service them. You certainly don't need more distribution centers or fixed capex. And so the gross margins are nearer 25% on a closer to 5%. So it's 5 times as much margin contribution from that customer as from the existing. So the marginal gain, that operational leverage is very high.
I read in your note, you said a 1% market share gain means another 15% increase to earnings, which quite phenomenal, really.
Yeah, but the flip side of that, of course, is if you're Asda or Morrison and you're struggling under the weight of the debt from massive leverage buyouts in 2021 when rates were 0 and they're now 10,
quite
effectively, you're going into reverse, aren't you? So you're losing a customer because you can't afford to decorate the stores. They look a bit shabby. You can't compete on price. And that's all going the wrong way, isn't it?
Yeah, absolutely. So even without market share gains, we think Tesco will outgrow Costco over the next 5 years.
Wow.
And if it carries on its market share gains, which it has been doing quite steadily for the last 5 years with that kind of level of contribution, I think they'll be in an even stronger position. So
just sort of coming back to a sort of theme that we've talked about in the pod for forever has been this sort of dichotomy between how UK investors view the UK stock market and UK stocks versus the US. I mean, Tesco and Costco is quite a good way of, comparing and contrasting. One's on 14 times and one's on 48 times. I mean, is there a sort of difference in philosophy and how we feel about the London stock market versus New York?
I think so. I mean, I've spoken to quite a few of the sort of brokers who cover Tesco, and they say it's their number one meeting with US clients, and no one in the UK wants to talk about it.
Right.
So even despite, I don't know, it's probably rallied 100 and something percent in the last couple of years, UK investors just still are quite down on it. But I think a lot of people have long memories, and having been a darling stock into the early 2000s,
yes, it was.
It really did destroy a lot of value for a decade.
Yeah.
I mean, Warren Buffett was the largest shareholder. It was a very well-regarded business like Costco, and they mis-executed very poorly. So it took a while to fix that. But I think people just have long memories and haven't recognize that it is changed.
And of course, Dave Lewis was part of that turnaround story, and he's now at Diageo. Obviously, Diageo's been a tough place to be. I think it's all started really with the inventory issues in Latin America, didn't it? But actually,
there's with the pandemic, really.
Yeah, there's bigger issues, or there were bigger issues than that. What do you? I think do you still hold it in the fund?
We still hold it, yeah.
What's your? It'd be quite interesting to hear your thoughts on that one.
Yeah, so I mean, look, what's happened to Diageo really? And I think there are some mistakes that they've basically owned up to through the dramatic exit of their newly appointed CEO. They've overspent.
Okay,
that's principally what's happened. I mean, their earnings, cash flow per share is sort of broadly sideways for the last few years when it should have been growing a bit, but it's not collapsed. So the fundamentals of the business haven't collapsed. Certainly at the moment, alcoholic drinks volumes are falling and they're sort of near zero growth or negative territory. But that slightly comes after a really complicated inventory cycle, not just the Latin American one, which is a slightly isolated incident, but just the massive destocking in COVID. No one could go out, no one could drink in a bar, to the massive restocking. And it was a slightly kind of roaring 20s, everyone suddenly had a bit of money in their pocket from stimulus and furlough and was released onto the world again. So volume went to the highest level of the last 20 years, and it's then come back down again.
As people drink what they've basically bought.
Slightly chewing through it, and there is obviously an argument that people are drinking less for any reason, whether that's the young drinking less and using cannabis gummies or things like that in the States, or whether it's people on Ozempic. There are arguments that people might drink a little bit less.
Is that showing up in the data?
So the Generation X or Z or whichever one is the younger ones these days, not drinking, it's definitely not influencing Diageo in a meaningful way, because when you break down their clients by cohort, the latest data we saw was that about 3% of sales went to that generation. Right. So even if it had totally stopped drinking, which I don't think is the case, knowing the few that I know, it would only have impacted it to an order of 3%. So I think that's very limited. The Ozempic data is it's real, factual, numerical data, but I think it's still quite anecdotal. When you start on Ozempic, you tend to start a new way of living. You try and be a bit more healthy. You're trying to get to the gym. Doesn't necessarily mean it sticks in any structural way. And the displacement to, recreational cannabis in America, which is the other big one that they're talking about. Again, it's quite hard to get fixed data on it. So I think the bigger thing though is to stand back slightly and say, well, look, what can Diageo do about it? And what is the prize worth going for? Because, marketing as a percentage of sales and advertising has gone up dramatically. It's doubled in America in the last 4 years. And that is ahead of itself. And that's really the problem. They have overspent ahead of, in the middle of this very strong volume recovery post-COVID, thinking it was some sort of new paradigm,
of course,
which it plainly isn't. And it may be worse than that. It may actually be a weaker environment for a few years. But, they've only got about 6 or 7% of the alcohol market. What competitively does this mean? How many more startup alcohol brands are going to come out and compete, like all those George Clooney type tequilas? That was a wave of VC funding, easy money funding that came from zero interest rates and a strong demand for spirits. That's gone. I wouldn't imagine people are going to be doing that with a higher cost of capital of say 5% in the developed markets plus. So I think that's disappearing. So your competitive environment's probably improving. They have the distribution and marketing advantages. They have most of, very, very strong diversified brand advantage. Guinness, which is a meaningful double digits of sales, is working. And you've got Dave Lewis in charge, who I rate incredibly highly from his turnaround at Tesco. He did the job brilliantly and kind of left the glory to someone else, actually, having left about 5 years ago. Yeah. But he set it up in very well. And I think if you were thinking about which one's easier to fix, Tesco of 10 years ago or Diageo today, it's got to be Diageo.
That's encouraging. Sure. And just staying on the sort of beverage thesis, your newsletter pointed out that you'd sold your Heineken.
Yep.
Which is obviously sort of a kind of historically a emerging market, growth, middle class, consumerism kind of darling, isn't it? Because it's got the distribution in large parts of Asia and Africa. So do you want to sort of talk us through what you were thinking there?
Yeah. So Heineken's obviously beer almost entirely versus spirits, which is a harder category, full stop. It's harder to premiumize. It's harder to get that kind of brand extension. But they are a very good brewer. the question is really where they've been deploying capital in the last few years, because 15 years ago, you got rewarded for investing in the emerging markets. There was faster growth. There was, as you say, emerging consumers. That didn't play out at all. That didn't work for consumer staples companies. As these emerging markets did mature, they actually grew up their own local brands a lot. And real competitors came in against you. And yet, I think despite that, especially with a brewing asset, you can distribute most FMCG products into emerging markets from outside or assembly in them. Yeah. A brewer is a very capital intensive industry, and buying or building this capital in these regions, we think is going to generate a very low return on capital for a large number of years. And we got the impression that the large family ownership was quite content with that. So sometimes investing in owner-managed businesses can be very positive, but sometimes they can have slightly misaligned incentives. Yeah. They want Heineken to be dominant and around in 30 years' time. This is me putting words in their mouth. They have not said this to me or said it publicly. Sure. But it felt like a good dividend and a solid and growing capital base to secure us to make beer everywhere in the future was a solid ambition. But that doesn't necessarily line up with that fundamental growth being as strong as we're looking for. And so it was a combination of that kind of M&A and capital allocation strategy. There's a couple of wrinkles too with their market in Vietnam, which is their second largest market globally. They introduced very strict drink driving laws and very strict post-COVID laws, which has just decimated tourism and drinking in general. And they've got a lot of fixed capital in that country. So there's a few different bits. Diageo's a hard stock. We've decided to hold on to it for now, which is a difficult thing to do because it has been struggling. Heineken is a hard stock too, but on the margin it was worse, and we just felt that actually it wasn't going to hit our targets.
Right. Yeah. Very sensible.
The other thing I picked up was historically you've had banks in the portfolio, and actually, I think whilst there's probably more excitement from the generalist around banks because of net interest margins, etc., you've actually been trimming yours. So you were in early, you've had a lot of upside from a number of names, but actually I think probably when others are starting to maybe initiate and go overweight, you're trimming. So it'd be quite interesting to hear sort of the other side of that trade. So
again, banks are quite instructive about how we think about getting into positions at Latitude. We will tend to invest in stocks when they're quite out of favor or just forgotten about or written off. That doesn't mean anything's going wrong. When I bought the banks originally in 2015-16, business was going really well. This is only in America. I haven't been buying any non-US banks. Correct. But JP Morgan, Goldman Sachs, Bank of America at various times over the last 10 years. And it was going very well. They'd recovered basically from the financial crisis and were paying dividends, returning capital. But they were completely out of favor. And for about 5 years, they were probably the stocks we got a lot of heat on in meetings. You can't own a bank. They're not good businesses. They can't be high quality businesses. But our analysis pointed to something different. We genuinely believe these companies were going to grow at least 15% a year, including the major capital returns. So that fundamental growth, including both. And the sharp return of interest rates, which we thought would come at some stage. We didn't know when in our 10-year period, but has juiced that further. So the stocks have generated, including, because the great thing about banks is they're quite volatile as well. So we have been able to trim and add a few times over the years. I think the sort of IRR or average return is almost 30% a year on that holding over the last 10 years. Wow. But they've gone from being, as you say, James, like sort of hated and misunderstood, I think, to have clearly recovered. They're trading with very high returns on capital, reasonably fairish, kind of, I think a bit cheap, but fairish multiples of book value and earnings. And they've had a big pickup in net interest income as well from the sort of interest rate optionality. So I still own JP Morgan, still very happy having 5% of the fund in US banks, if you like, but have cut that back quite substantially over the last 18 months in favor of other places.
Yeah, that's really interesting.
And then a stock perhaps that not many will be familiar with. I mean, France isn't known for its entrepreneurial dynamism, settled political climate, all the good stuff that we look for as global investors. But one of your bigger holdings is a company called Vinci, and we'll pop the chart up here to show, which it's nice to see the line starts bottom left and top right. Do you want to sort of talk the listeners through We've got a few graphics here as well that I picked out from your pack about what Vinci does.
Yeah. So speaking of entrepreneurial businesses, it's been around, God knows how long, sort of, 100 years or plus. And it basically used to be a large sort of civil engineer, building hospitals, bridges, roads, things like that. And then about 20 years ago, it made a business shift to being an infrastructure owner and management of it. So they build and own toll roads or bridges or airports, and they buy up some secondary assets in those spaces as well. And so, as you can see on the bottom pie charts, about 80% of their profits now come from operating toll roads. And so these are direct, inflation-linked, government-sponsored contracts with anything from the shortest end, 10 to 15 years left on the concession, all the way out to beyond 100 years on the concessions. And then with the other 20% of their business, they have a construction business. It's called an energies business in predominance. It's really fitting out lighting, heating, HVAC, things like that. It's quite small contract. So not the big civil works of old with all the contracting risk. It's one of the fastest growing areas of construction across the world, and notably in Europe with a lot of the environmental regulation coming through. Yeah, of course, it's got, very, very steady, very high returns on capital coming through that business to augment and allow them to deploy more free cash flow into more infrastructure assets as well. It grows around 9 to 10% a year and pays about a 3 to 4% dividend, depending. I think the dividend's going to go up over the next few years. So it definitely hits our kind of sweet spot of being in that 12, 13, 14% intrinsic value, fundamental value growth. It's quite complicated to model. When we did, one of my partners, modeled asset by asset for all of the large assets on their balance sheet. But when you do, and you put it together, it's a very simple business to understand. It is in France. There is political uncertainty. There are, there's plenty of things to give you a pause, but it is on 11 times earnings as a result of that.
Right.
I forget what it did last year, but it's probably, it jumped around towards the end of last year, but it was up about 30% last year, something like that. Still on 11 times earnings.
For 14% growth.
For 12 to 14% growth. Inflation protected growth as well. Inflation's gone at the moment, but plenty of things we see. We're very happy that the vast majority of our holdings will be direct beneficiaries of inflation should it come back. We assume 2% inflation in all our estimates to get to those figures, but it's a free ride on top, we believe, across the vast majority of our portfolio. And this is one where it's directly contracted.
Where do you see those inflationary pressures coming from, if any? Is that just sort of a hedge, if you like, against inflation, or can you picture a scenario where inflation does come back to bite us?
It's more that I can picture many future worlds, and one of them is very inflationary, rather than having a view. As I said, none of our estimates or ownership of these stocks relies on inflation. We just assume a flat 2 across the board when we're doing our modeling. But, the amount of money printing post-COVID, all this talk about reducing Fed independence, other central bank independence coming back. We're in a rate cutting cycle already, and the economy's pretty hot. And just, historically, when you've printed a lot of money, supply, it's tended to lead to inflation at some stage. But that doesn't mean it will. We could have a depression instead, but it's certainly worth being hedged against.
Looks like a new potential Fed chair is more concerned with employment data than inflation as well.
Yeah.
From what I've read, it sounds like he's quite happy to keep cutting. So you've got that added on.
Yeah.
I remember something when we met, actually before we did the podcast, and we talked about the US dollar. And I remember you saying the big risk to the dollar, which sounded completely alien at that point, was that it could weaken. And it wasn't because you thought the US was in a bad place. It was just, if you looked at long-term trend lines, it was trading well above the basket of currencies on the other side. And it wasn't so much you thought it was going to happen. It was, there is a big risk that it could, and you've got to take that into account. And no one else was thinking about that. So I always enjoy chatting to you because you always think about the other side. And I think lots of managers think with the consensus and don't question it.
Yeah.
It's interesting. We've been talking about inflation surprising the upside just because everyone's thinking the other way. And also on the oil price as well, as every single person out there thinks the oil price is going to continue falling. It might do, but there's a lot of trades that way, which means it probably wouldn't take much to flip it around.
Yeah, I think the key thing with these sorts of risks and the way we think about macro in general, to the dollar point and to the others, don't bet on an outcome. I think it's pretty clear no one's got a clue what's going to actually happen. I mean, it's astounding how many people still make those claims. But if you can build a portfolio that's robust without being exposed to a risk, do that. That's all we're trying to do, is just try and make it robust, whether we hit inflation, whether we hit recession, whether we have dollar weakness, whether we have all these things. So an awareness to what has happened in the long-term past, i.e. what's already definitely possible, because it has happened, and then an awareness of things that could happen that haven't even happened. And if you can try to avoid those in, broad brush strokes through your risk portfolio construction, I think you've got a better portfolio. You never quite know, because sometimes the risks don't come to pass, but risk is very much what could happen, not what did. And that's always how we think about it.
Yeah.
That's quite similar to, one of your global fund manager competitors, I suppose he'd be Terry Smith, who's had it's fair to say he's had a pretty difficult few years. He buys a sort of cohort of stocks known as kind of quality growth, Diageo, Nova, Nordisk, a lot of stocks that you probably wouldn't own. How do you, and we most days comment on the cohort of stocks in the UK market that aren't necessarily, that are sort of tied up a little bit in AI disruption, potentially software, whatever it might be, Relex, Experian, Diageo, I suppose, LSE to a degree. I mean, have you got any sort of quality growth as a sort of style has been horribly out of fashion for 2-3 years, as as illustrated perhaps by Terry Smith's kind of more recent performance. Were those stocks just too overvalued and therefore they had a sort of time of comeuppance, or has something really changed and we've moved into a slightly different world where we want to be ignoring quality growth completely?
Yeah, so I've got a fair few things to say about this one. Look, I mean, quality growth is a marketing phrase.
Right.
It's not a sensible classification of a subset of stocks. We believe every portfolio business that we invest in is growing. And obviously we think we can own it for 5, 10, 15 years, owned over half of them for 10 years. We think they're high quality. And JP Morgan is a quality stock that has grown consistently for 25 years. What's not quality or growth about it is it doesn't fit in that definition that whoever came up with it created. It also has a high return on capital, which is in the definition. But so I think it's a really dangerous thing, and it's one of the, I don't know where it came from as a phrase, but I think it'll disappear because it ended up creating this, herd-like behavior in a very short list of stocks, 50, call it, stocks, a lot of which we would own, actually. We did own Novo Nordisk, for example, sold it years ago when it was too expensive, like 2022. But a lot of which actually aren't even as high quality as you think. They just tick the boxes. They have a high return on capital presently. They have low variability of earnings, which I think is meaningless, and they have good balance sheets. Not intrinsically stupid ways to look at quality, but you can't reduce your research process, which needs to be very qualitative and very in-depth, to a tiny list of quantitative factors. Especially not when companies realize that if they game those factors, they get a higher multiple because that's where the capital was. And so you create this poor behavior in both the research community, in the fund management world, and also in the management of these businesses. So I think it's been quite damaging. I mean, I think there are, we've had a good 5 and 10 years and a good last year. We buy businesses that are growth. We buy businesses we think are high quality. The market is broadening out. I think that will be a feature of the next 5 years, continued breadth. And I think when we look at the list of stocks that basically constituted that kind of Nifty 50 or those sorts of portfolios.
Nifty 50 was a phrase that sprung to my mind, which is probably where it started, right, with the sort of IBMs and the Cokes back in the day.
Well, that's it. You couldn't get fired for buying these sorts of stocks 5 years ago. But I'd say quite a few of them we don't think are as high quality as people suspect. And that would, some of those software names, some of these price gouging information names, and various other ones, where the competition is actually scarier than perceived. And a lot of them are just far too expensive still, So even if we have 25 of the 50, say, it's not a well-defined list. But, even if we had 25, and I'm sure we've got some in our portfolio, but 25 on our shelf of ideas, we're not buying them because they're still twice the price of other things we can look at. So there's a lot of reversion to come.
And then just on sort of moving on, it's got a good way to sort of almost round it off is with this. We can't really have a podcast with a global fund manager without talking about tech, can we? So
yeah, we can do it.
And AI. So you own Alphabet.
We do.
But you don't own Microsoft.
Correct.
And do you want to sort of talk us through how that's all come about and then sort of where you are with them?
Yeah. So owned Alphabet since 2013. Mm-hmm. So it's not sort of a new call. Owned Microsoft from 2011 till a few years ago and exited. So both great businesses. You know, I think they've both got fantastic distribution, nice diversified business models, huge amounts of cash flow, wonderful balance sheets, pretty good management teams, etc. So both good businesses. So this is not me to here slighting one of them.
No.
It principally does come down to valuation and the growth that you get for it. And, you know, if you look at I can't read that chart from here, but I think Microsoft's grown at about 15% a year for the past 10 years, you know, and that's been an extraordinarily positive time for them, launching 365, moving all to SaaS, you know, all the rest of the rollouts that they've had, Azure growth coming in, you know, Teams through COVID, the huge amount of growth that's come through that business and success, and they've delivered really nicely, 15% a year. From here, you know, Microsoft trades on, I think, about 35 times earnings. I can't see that chart again, but it's around there. But if you look at it on a free cash flow basis, it's closer to 60 times if you properly account for stock-based compensation. So somewhere between those two is a fair multiple to judge them by. What do you think the future looks like? I would say plausibly in line with the past, which would be very strong and great. And that's the numbers that we have there on the light blue chart. Even if it does that, if the share price comes back to a sort of more normal multiple of maybe 20 times, your return on capital is going to be less than 10% a year. But also, AI is very uncertain. It could do better, but it could do a lot worse. There could be a huge amount of wasted capital. And so that is partially true for Google as well, right? Google is also rolling out AI, but I think they're doing it in a much better positioned way. And last year, I'm sure you guys know, but your listeners may not, you know, Google was treated for the first quarter or so as the real loser.
No, totally.
AI is going to smash this business open. It traded on 16 times
Google
earnings.
search ever again.
And then the stock, you know, one of the very largest businesses in the world, doubled. It just shows you how inefficient markets are. And so now it is sort of perceived again as being a winner. But we wrote in January last year about how we think actually, given the high levels of uncertainty, it's still rational for these big players to be competing. You know, you need your seat at that table. You have the cash. The best ones are Google and Microsoft because they have the ability to absorb those, if it is misallocated capital, to absorb that back into their core businesses through cloud. So it may get a low return on capital, but it's not like just completely wasted. Google has the best data. It probably has the best AI infrastructure because it bought DeepMind 12 years ago. It's been rolling it out across its franchises. And it has the best distribution. And I think those are the three things that make a mark of who you think will probably have a stake to be successful in an AI world. You know, we're not looking at the very new disruptive companies. We're just looking at that in the position. So we see Google as quite well placed to plant good AI through Gemini or otherwise in Android, in Gmail, in Google Maps, in their browser, across their platforms, in their autonomous cars, in Waymo. They have so many different deployable use cases, and they are also finally building their own chips, TPUs, which are basically the postcursor to the GPUs, which superseded the CPUs. And Meta are now buying Google's chips as an example of how good they are. So I think they are well placed. I think the world's very uncertain. I'm annoyed it's gone up so much because it's forcing a bit of a decision for us. But at the moment, we do still own it.
And on the tech trade, is it valuations that scare you, or is it the earnings growth they've achieved that the market's expecting going forward? Where do you think, you know, we've talked about a bubble a lot, and if you look at, you know, from our point of view, if you look at valuations, they're sort of they're not crazy compared to what valuations have been historically, but is it the earnings that are more of the concern, that they can these massive businesses can keep growing at the same level?
Yeah, I mean, it's both. And I think it's always both. With every stock we look at, it's what are you buying? You know, if you're buying something for 10 years, you're not buying it because you think it'll go up a bit on rating. You're buying it because it's going to grow. And so it's the price you pay for the growth. That's how we think about it. And, you know, obviously we don't have just a single estimate for the future. We have a range of outcomes. And with the tech companies, Google included, those ranges widened quite substantially in the last 18 months because, of course, AI could be incrementally more positive, but it also could be very negative. And so you've got more uncertainty, not necessarily downside, but more uncertainty both ways. Despite greater uncertainty, you have much higher prices. And when we look at other companies around the world, whether that's Tesco's or McKesson or Vinci or any other business, we line it up great business to great business. We don't buy Microsoft because it's Microsoft. We buy it because we don't own it. But we would buy it because it's a good or cheap price for a strong level of probable growth. And I can find companies I think will probably grow faster, probably probability weighted than Microsoft, not than Google. Google does grow faster than most. At a third of the price.
Yeah.
We own half a dozen stocks that are growing in line or faster at a third of the price. So, which I believe will also be around in 5, 10, 20 years time and have a stake to claim in their industry. Yeah. The final point you sort of hinted at there, James, is, how big can Microsoft get? There is an element of a law of large numbers. If you keep growing at 15, 20% a year, and I would argue the Microsoft share price is really baking in something closer to 20% a year, which is doubling its profits every three and a bit years. How long can you sustain that?
Yeah.
Without,
who's paying it?
And then I guess it comes back to NVIDIA as well, doesn't it? It's not necessarily the valuation on NVIDIA itself, are those earnings which have gone up 10x, 12x in the last 3 years? Are they going to continue to grow at that rate, or are they in a sweet spot today that's probably not going to be repeatable for the next 5, 10 years? And those are the kind of so to your question, which was a good one, is it the valuation or the it's both sides of it. Will the earnings keep growing at this rate forever, which is what they need to justify the valuations, or are the valuations too high? So lots of food for thought, and there's lots happening in the world, and it's been a busy start to the year. And we should probably call it a day then, because you're due on with your next meeting in 4 minutes' time.
Okay,
Freddie.
fantastic.
So, anything else you want?
No, I'd like to ask lots more, but time's up, so we'll have to get you back.
All right, anytime.
That's great.
Thanks
so much, guys.
Thanks very much for listening and watching today. I hope you enjoyed. Any questions, get in touch with james.hughes@quiltercheviot.com, or I am jonathan.raymond@quiltercheviot.com, and we'll see you next time. Thanks very much.